Good deal. Real Fridays is just about to start. I actually did it in reverse this time. I actually started the live stream to LinkedIn and to Facebook and YouTube before.
Live?
Yeah, so we're live, baby. We're
man. We don't have post production. We don't have beeps. You got a delay?
No, this is exactly. There's no beep. So anything, anything you said.
I warned you before I said I was coming.
Anything you say can and will be held against you in the court of public opinion in the mortgage business. So this is totally fine. It's funny. Brock didn't even know that Jason, you were going to be coming on board for this call as sort of the secret special guest. No, you two remember each other at the Housing Wire conference, correct?
Yeah.
Brock run NewsZip.
Run out of guests. I mean, did like somebody die, and that's how they had to.
Well, we weren't planning on having a guest for this week, but I thought it was timely.
Jeremy's dead, actually.
Well, yeah. I just thought it was timely. So let's just set the stage a little bit, and I'll explain why I think, Jason, it's timely to have you on board. But for those of you who are watching this in weeks and days or weeks ahead of or trailing the recording of this videocast, this is Real Fridays. And so I'm Rick Rock. This is Brock Cassidy and Jason Harris. And Jeremy Potter will probably be late or not attend this time around. But the intent of this podcast is really to focus on insider information that isn't necessarily inappropriate, but it's real like feet on the street, boots on the ground, relationship driven, that's intense, that's serious, that's focused, but also that's fun around what's happening in mortgage, real estate, and housing. And obviously you and I, Jason, represent, I think, a lot of things, but we represent really the independent mortgage bank sort of sphere of the nuts and bolts and the mechanics of how housing is financed in America. Brock represents really a kind of a real estate tech innovation angle of trying to sort of change the game from a tech standpoint, coming from Rocket and then now running as chief revenue officer at NewsZip. And then Jeremy's cool because he represents the legal aspect of it, combined, kind of fused. He's really a leading lawyer in the business, in my view. And also he's also an innovative thinker around product design and what's the real intended efficiency that's supposed to be the outcome of what we're doing, and to help companies and technology vendors sort of move in the direction that makes the most sense, right?
Surrounded by giants. I'm way out of place here. I mean, you really. I saw you had Cher on here. You had Calabria. I think you had Crispin. Like, what am I doing? I'm way out of place, guys. I'm outclassed.
You're a CMB. So that's you know.
I took a test. I read a book and I took a test.
Hey, well, look, my interest in you, Jason, over the years has been, I actually think that you are very much, on the thought leadership of the business, because you're molding and testing and working with really probably arguably maybe the next generation of certified mortgage bankers, because they're climbing the ranks, getting their CMB. And you're testing them, you're building the tests and so on. But I actually think that it's like we're all old enough to be senior leaders in the business, but we're young enough to really still have a lot of runway to have our mark on the business, right?
Yeah.
And I'm at the stage now, like you are, Jason. Brock is still not old enough, but Jason, like, I think we're at the stage where we want to really shake things up. Like, we really want to create some damage from a market share standpoint, as well as from an innovation standpoint, so that we can leave our sort of generational mark, on the business. But Brock is already doing that in a lot of really innovative ways. I would say, I know when you're at Rocket, everyone thinks like when you're at Rocket, it's a very insulated environment, because at Rocket, it's like you don't really know the mortgage market at all. All you know is really Rocket, right? I remember talking.
I was like very well networked there, right? But there's 28,000 employees there when I was there, so it was like that was enough to keep me busy for the 7 or 8 years I worked there.
And what's funny is and Brock knows who I'm talking about, but there was a senior executive at Rocket that I worked pretty closely with, and I was shocked at how little he knew about the business. he knew a lot about Rocket and a lot about systems and products and product strategy and implementing systems and, but he had no clue. When you said like cross country mortgage, he'd see like, well, who are they? And I'm like, who are they?
If you're Rocket, you probably don't need to know who all these other IMBs are, right? Like you got so much market share.
Well, that's crazy. Even as big as Rocket is, they're only 7 or 8% of the market. So the mortgage pie is pretty, and that's a massive piece of the market. But cross country is only 3.5. So it's like, you look at it and you think that's big, and you think that that's all there is to know. But then you swim and you're like, holy shit, there's so much more to the mortgage business than what's within the walls of Rocket. I'd never heard of Brock until he left Rocket, until they released him from the dungeons. And then once he's out in the business and innovating and networking with credit unions and all these people that Rocket doesn't even know about, but he's now having an impact, like one match at a time in this forest fire of trying to light it up, called the mortgage.
That to be the case though, like in a lot of our industry, people don't necessarily, they don't generally delve outside their silo, even within IMBs. There's not that many people that have a grasp on the industry like holistically. Most of your leaders they're older, successful sales guys, and then they supplement their knowledge with some sort of operational integrator. That Rocket example is no different. Like people, they don't really look outside of what they're doing and really get a feel for the industry as a whole, generally speaking.
Yeah, one of our quick story on that. One of our investors, who's been really good for NewZip, comes from a deep banking, depository banking background, and has done a really good job. That it's been helpful in a lot of ways. But it's kind of funny. They've matched us with all these general banking executives to give us feedback on our like very particular, somewhat niche mortgage products, right? And the feedback was good to understand like how they buy and how they think about things, but it was not anywhere close to our product. And that was investors and mentors and everyone that surrounds NewZip. We always get those kind of conversations, and it's like, I had a different bias when I came into this job, but like it was, but everyone has their own, right?
Yeah. A lot of people don't understand others' experience in it. There's a lot of people that don't understand mortgage banking as a whole. Earlier in my career, I was at Capital One, and they were, phenomenal at credit card, consumer lending, even home equity, right? They tried to apply those same things to traditional like retail banking and mortgage, which are more relationship industries. And it was, they had a tough time getting their head around it. I think they eventually did, but like while they were learning, these are totally different facets of lending. It's not uniform, and it took them a while to acquire the experience. And it was, if I recall correctly, and listen, my memory may be clouded by some recreational drug use as a child. They had a tough time those first little bit. So it's I don't know that people don't study enough about how the whole thing works.
There was a post recently done by someone, I forget who, it may have been Greg, and it was around what, like, in essence, banks coming back into the business, right?
Yeah.
And I'm curious as to there's two questions I had for you, Jason, and Brock too, because Brock's been really heavily involved on the depository side of rolling out sort of solutions, technologies that will connect sort of depository LOs with real estate agents and the borrower into some really sticky kind of process. Is that the statement was that banks, it was some news article or something about how banks are tooling up to get back into mortgage. And I've gotten some inside information that like Wells Fargo is going to make a really strong go at it again, because when rates go down, refinances will come up and all this other stuff.
Can they though?
What is your take on that, Jason?
Well, I mean, Wells Fargo as an example, like, don't they have a regulatory cap on their balance sheet where they're at the ceiling anyway? So
I don't know.
Yeah, I think that's why they got out in the first place. Was that they hit the cap or something, right? Am I wrong on this? I mean, is this the bong resin still? Am I right? I'm pretty sure that was the thing.
You know,
They had to they had to divest because they were at some like a SIFI hurdle where there was some. I don't know, man. Maybe I'm making.
I know when I was at the tail end or the middle of my time, I guess at Rocket was when they passed Wells to be number one for the first time, and in mortgage market share, and there were some different pieces of why Wells was getting out of the business. I'm sure I had like a very shrouded view of that as well, being at Rocket at the time, but I didn't know that. I thought they still were generally trying to grow in the business. I don't know. Do you know, Rick?
No, I swear that was one of the things when they brought in Charlie Scharf, that he had. It was some like punitive thing where they were at an asset cap for a SIFI. It's something like that where they had to get out. I could be totally miscaught. And if you got fact checkers out there, they're going to call it my bullshit.
No, that's okay. No, look, Wells was punished for kind of the false creation of accounts, right? And I think that so I don't know what their caps are. To be honest with you, there's an industry consultant that I spoke to recently who indicated that there was a lot of chatter internal to Wells around reemerging as a real sort of player sort of in the business. As of right now, they're I'll have to pull up their numbers.
Servicing portfolio still, I think it's a massive number. It's like $1 trillion.
Well, and I think that that's partly why, in anticipation of rates going down, I don't think anyone has seen that yet. As far as, obviously none of us have really seen that at this stage, but as far as, as the Trump administration sort of takes root and their plans end up sort of, they've done about $28 billion in loans to date, year to date. Over the last 14 months or so about roughly 12 months. But so, they're number 6 in total volume production behind US Bank. But these larger lenders, to me, it's a matter of them just making the decision to go in, to be honest with you, if they wanted to go
market, if you got the kind of capital. There was something else too for why a lot of them exited, and a lot of this has changed because I think it's.
That's where Mike indicated. Wells' asset cap is gone. They got out of mortgage because of all the regulatory issues they had with servicing.
Thank you, Mike.
Now the issue though, and I don't know what getting out of mortgage really does. If getting out of mortgage puts them number 9 in total volume,
right?
I don't know how.
Yeah,
they shut down wholesale and correspondent. I think was. Kind of what they did. They were going to continue to service their bank clients, but not really delve into the other channels.
Yeah.
There was also something weird, and I may be totally wrong on this, but again, with the memory, there may have been some shrooms in there at some point. There was like a DOJ thing with government servicing where you could go after the servicer for like reps and warrants, like violations that occurred during origination. It was some sort of thing like that where it I want to say it was like 2014-ish, where a bunch of banks on Ginnie Mae servicing were like, we're not interested. And if I remember right, at the time, they were actually paying you to take it away from them. Some of the Ginnie Mae issuers that were getting paid to take servicing off of these banks. That may be an exaggeration, but it was something. There was a regulatory thing with Ginnie servicing. Maybe somebody out there can tell us if that's true or not, or if I'm just like spitting alternative facts.
Mike Kush is continuing to give us some good stream of
there you go.
His references.
Well, they got CRA requirements.
That could be, but if like I said, I get back to my original point of if for them getting out of the business means that they're going to do 28 billion.
Right. What does getting in mean?
Yeah, no, it's pretty. I mean, cross country has done about 42 billion. So I mean, it's like being a top 10 lender is nothing to sneeze at, and if that's them getting out of it, it's a really interesting thing. But I just think that I don't know how depositories are going to compete when independents can invest in technology and invest in AI, for instance, I just don't know how the bulk of depositories are going to be able to compete on a cost per closed loan basis. I just don't, other than just portfolio products that they simply are going to rob Peter to pay Paul. They're going to make money on other products and simply just cannibalize the mortgage product. I just don't know how they're going to do it. I mean, they barely can now on any broad scale,
Yeah, what we've seen, and I'd never worked with any depository institutions until the last 2 years, I suppose. So it's like very recent information. Had always been IMB world, even in the partnerships I built at other companies, and of course Rocket. But what I've heard a lot in the last 6 months, 9 months, like this year to date, was that some credit unions as well, but mostly banks, that they'd gotten out of any kind of mortgage specialty, but they were allowing like branch employees to do the normal stuff, right? They were making offers to their, through their online banking portal, like you see on Chase or whatever. But it just hadn't been a priority. So what I've been hearing a lot, and people that come to NewsZip are tending to be referred to us or find us because they're looking to grow more like centralized, like direct to consumer style, either marketing or actual lending operation, or both in most cases. So what I've seen a lot is the very early stages, the seeds of some of these institutions, saying, and some more aggressive than others, of course, saying we're going to start hiring like real mortgage people again, or specializing real mortgage people again under the bank, heading, under the bank banner. Whereas it's not like they got out of it, but they were just letting branch employees do it or whatever. And obviously because federally chartered banks can lend in all 50 states and all that good stuff, they have some more flexibility to pick their spots. So I've seen a lot of them saying, hey, we're going to try out rebuilding a centralized call center office for these 5 states or whatever. And if it works, then we'll go to all 50. So we've had a lot of this kind of like test type conversations, like put a 1 foot back in the canoe of specializing in mortgage. But I've limited data there. It's been a pretty recent set of conversations, but quite a few of them.
That might not be bad though. I mean, if you look at where the industry has gone, right? Like we become totally commoditized. Everybody's selling Fannie, Freddie, Ginnie widgets, all of us, to the same people at the same price, and the same people are like the same 10 aggregators, right? There's not a lot of competition. So maybe the competition alone shifts that, where they have to compete on something other than just price and service, and maybe it goes. I don't know how Dodd-Frank would think about that, but maybe they have to come up with some alternative products to get more creative to chase that yield.
Mm-hmm.
It might not be bad.
Yeah, some more balance sheet type stuff too, like some different types of products. Yeah.
What's the percentage share right now of like non-agency lending? Is it 10?
It's less than that. As far as like non-QM.
Yeah.
Yeah, I mean it's like 5-6%. Yeah.
Yeah, non-QM. I mean, but also lump in non-conforming jumbo, like jumbo QM, but you got to shelf it, or you're going to securitize it somewhere. Like
I could be wrong, but I think I think jumbo is only about 1%.
That's what I mean. Like there's not a lot of that whole.
Yeah, it's got to still be under 10% for all that.
Yeah.
Crazy.
So maybe maybe the competition spurs some, I don't know, creativity, a few less widgets. I mean, I don't have a problem with widgets. Like widgets are great. We fit lots of people into widgets. We make money doing widgets. But I remember a time way back when, in like 2005, when we had more than one thing to pick from. Didn't always go well, but there was optionality. All right, that could be a thing. I mean, I guess if you're working on technology, wouldn't that make it more challenging though? Because you have now, instead of one basically stable workflow with minimal variation, you've got these other things. So wouldn't that complicate it for you?
For our company personally, I think a lot of what we've done is try to make it easier to attach like different types of different things to different channels, right? Like if a lender has a really robust first-time homebuyer program or VA program that they want to bundle in real estate benefits with or whatever, that's like something we do all the time. So we kind of applaud the creativity of trying to like specialize in new channels or create value in new channels. But yeah, at the end of the day, like even those loans, they're still basically getting the same offers. They just may be getting some additional credits or some additional, benefits downstream from partners or whatever.
You know, did you guys read the Housing Wire thing that they put out with the forecast?
I just downloaded that. What was the thesis of that? I haven't read it yet.
I don't think it's anything you didn't expect. It's a range of best case scenario, worst case scenario. We're going to kind of chop it in the middle.
So what was best case? Was it north of $2 trillion? What was there?
It was just existing home sales, I think, and then they cited everybody else. Generally,
it looks like they put out their base
5% year over year on existing home sales with effectively the same home price appreciation. So not stellar, but not catastrophic either. I've heard everybody says the same thing. He's got a great. They've got a great stat where it's the forecast of like 10 other economists or firms. So it's like got Goldman, Freddie, MBA, Fannie, like they're all in there. Like it's a great summary, and theirs is pretty much right down the middle. Mm-hmm. So maybe this year is not the year for these banks to get back in it. The volume is not going to be there. At least that's kind of base case.
I was just looking at NAR's projection on the real estate side, and they said 9% increase in home sales.
They're optimists
in 2025, which would still be very low, but yeah, they are optimists. There's no doubt about it. So that almost gave me pause that they only called for 9%.
Yeah. So I mean, to your point, like the banks getting in, I mean, would it drive competition maybe to open up some more products? But there's not a substantial amount of inventory for anyone to work with anyway. And in barring some economic disaster recession scenario where everyone's wrong on interest rates and suddenly there's a refi boom, there's not a lot of banks. There's not a lot for them to work with, right? Like volume wise. So, I mean, is whatever volume share, market share that they think that they're gonna grab? I mean, would the risk be that they're gonna grab it from IMBs? I don't know. I think they would have to attack it through like correspondent or something. I mean, that would be, or wholesale, like all other channels. I don't think they could just go into like retail.
I think the base case is that they're just trying to keep their own depositors. So that, I don't know, that whoever their depositors would normally go to, IMBs probably. But that's most of them, that's like phase one. I mean, I don't know. We've heard of some that are trying to buy leads and expand more outside their sphere as well. But yeah, I have limited data, like I said.
I think there was an NBA article that showed that I think it was Q3. IMBs actually made money. It was like an average of a couple $100 a loan, right? But that's the first time in 3 years almost. I mean, since basically 2022 Q1, right? Maybe Q2, some people made a couple bucks, but from Q3 on, it was losses. If these banks were really smart, they would just be buying up some IMBs that had depleted all their cash, run out of PPP loans, run out of ERC credits, and now don't want to write another check to keep all their regulatory approvals in their warehouse open. Like that would be a way easier strategy. Without having to build something new, like, hey, look, just come on board. And a lot of the smart, bigger IMBs, I think they do that same kind of strategy. Like, hey, you just join our family and make it easier on yourself. I think that's.
I even think
it's scary as an industry.
Yeah.
Because of the concentration, but what's the alternative?
Yeah, I even think about that with like all the conversation there's been recently about servicers competing with the originators. that sold them, MSRs and all that good stuff. Is like,
oh my gosh,
is that just going to consolidate a little closer, and servicers and banks might be in the market to buy small IMBs? I don't know.
That servicing thing is real. As an IMB, like we hear about this all the time. We don't. I'm at a place we don't service. Everything is servicing released, and as soon as these things get transferred, like they're getting letters that we could streamline you today, and yada 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 yada. None of them are real because they don't meet the Ginny requirements of the 6-210, but they're getting the thing like. As soon as that servicing is transferred, it comes like with the hello letter.
Yeah.
Like, here's a hello letter. We'd like to refinance you. It's crazy. That's pretty crazy because the EPL risk is real.
It's interesting. So what Housing Wire predicts that we're going to be in the 5%, 5 through 3/4. Oh, well, okay, got it.
Yeah, look at the range, dude.
Yeah, exactly. So they're really going out on a limb.
Yeah.
5 1/4 to 7 1/4.
Yeah,
right.
Good.
You're going to be somewhere above 0.
So it's because that range is the difference between
go back to that chart with the bubbles, right?
Like
that
2.5 trillion to like 1.8.
Yeah. They probably. I would give them credit and say because their research is pretty thorough on this. I would bet that they had a tighter range before the election, and now they're looking at maybe the outcome of some of those policies because I don't know. Obviously the pollsters were way off on this.
Well, with inventory, what's interesting is so they're one chart I was just looking at. This is incredible. The spread between the 30 and the 10 year.
Yeah.
That's so dramatic, dude. I don't even know if we'll see this again in our careers in the next 10 years.
It remains so. I mean, that's a function of uncertainty, right?
Yeah.
So it may remain elevated unless you continue to see inflation decline.
Yeah.
The Fed funds futures, they really haven't changed. So, I mean, they're still saying, 4.25. I think June 25 or September 25, something like that. 4 to 4.25, somewhere in there is like the range towards Q3, Q4 next year. Yeah. So if you put like a 150, 175 handle on top of that, you get the numbers that we're talking about. The only thing that would change that would be a change in the rate of inflation. Otherwise, that's everybody's looking at 5 7/8 or high 5s by the end of the year. That's what every bank suggests.
So I'm wondering, do they actually forecast the actual production volume forecast?
Not in this.
Oh, that's just
no. Yeah, if it's in there, it's cited they're citing like the Fannie and the MBA forecast, which I looked at them. I have them. I don't know where I have them, but I looked at them because I use them for my own forecasting. So
under most economic scenarios for 2025, we're expecting home sales at about 4.2 million, which represents 5% increase over 2024. The issue there is if 30% of those are cash, then we're only looking at 3.5 million mortgages, which puts us under 2 trillion.
Yeah.
That'll put us at 1.6, 1.7. If that's true.
Get some refis. Assume if you get a 5 3/4, there's a couple of those bubbles there that had refinance activity in them that were, like eligible, that were originated in late 22, mid 23. So some of those people, I think, let me see what I got here. I looked at these myself. So MBA total volume year over year, this is earlier than this. Their forecast was up 31%. Fannie's was a 26% forecast, like year on year increase. It was a lot of purchase volume, like 15% purchase, but the refinance was really where it all came from. The refinance.
I don't see it.
It's a huge increase from 0. What's your refinance percentage this year? Like it's
probably 5%. I mean, it's not zero, but I mean, I get you. It's next, it's probably 10%, of total production volume.
Yeah, mine is like 6.
Yeah,
and it was lower until just this past quarter. So if you double that, it's 100% increase of not a whole lot.
So I don't know. So I guess the question is, I'll have to really dive into this. I'll kill.
I don't think there's anything revelatory in there. It looks like it's consistent with all the major economies. The only thing that was really interesting to me in reading it was the Goldman stuff was really conservative. He's got some Goldman forecasts in there that he pulled out. That's what I really like. They did a great job of compiling stuff.
Yeah, I think the only thing I want to press leaders to do is to take risks and to really kind of say, like, this is where I see the market really going. This is where, yeah, I mean, it's almost like that line in the movie. What's the name of the movie? It was a Zero Dark 30, where they go through where like the head of the CIA goes through, and it's like, what's the percent chance that Obama that Osama bin Laden is in this particular location, and you get all these like analysts who are like 30%, 60%, 70%, and the person who's been studying it like for the last 15 years, the CIA officer, the woman, she's like 100%, no 100%. It's at 100%, and they're like, well, we're analysts, we don't deal with 100%, we don't deal with certainty with the ranges, and she's
right.
like, fuck that, like it's 100%, he's there, go pull the trigger, he's there, and I just feel like sometimes as leaders we can't operate as in this ambiguous range. We got to say, like, look, either the market's going to go in this direction, or we're going to steer, and this kind of gets to my point about better, we're going to steer the market in this direction, right? So I think his comment about 99% is going to be automation and bots and AI, and 1% is going to be the actual originator. I think there's some leadership behind that to say that, like, look, I'm forecasting where I want the market to be, because that's what I'm tooling up my company to be, which I don't really think he's that far off from being right. I'm not saying that 1%, that 1% still could be the most meaningful piece of the transaction, because you're dealing with consumers who don't speak English. The consumers who are, who've never owned a home, their first time home.
Don't have a computer, don't have a smartphone. They exist. Don't have internet.
Don't have email. We see don't have email all the time.
We have people here too. Also, no email.
Yeah,
come to the office.
Dude, I've done loans for VA loans with consumers in the Midwest, for instance, like, that are Vietnam vets. So those guys are in their 60s and 70s. And they're taking screen grabs, and they're taking of bank statements and stuff. It's like, no, send me the whole bank statement. And they're like, no, I'm not doing that. I don't want to email it.
Yeah.
Okay, I'll go with you to your credit union. I will sit with you in line. I will go. I'll tell them exactly what I need. I just need you to nod. Yes, this is what I need. And the teller will give me what they need, and then you'll get the actual physical handprints. I mean, that happens more often than you'd think
today.
Yeah.
I think if you take a longer time horizon, I'm not trying to be morbid, but those people are going to die, or at least stop borrowing, right? And so the eligible consumer that grew up with a smartphone in their hand, there's going to be more of them. That's going to be, the base case.
That's right.
I was at the Lending Tree Summit where that comment was made on stage on Tuesday.
What comment? That everyone's going to die?
Not that one. The 99%. It was that would have been morbid for a mortgage conference. But no, they were. The question was interesting. The question was from the moderator was, do you, and it was Rates CTO, and then Better's CEO, and then a couple tech folks on the panel, as I recall. And the question was, do you think AI will get to be more than 80 or 90% of the time that loan officers have to use or that lenders have to use on loans today? And there were a bunch of qualified answers. And then, I really do think it was a lot of talking their book of Better is betting as aggressively as anyone on this trend and continuing to lose a lot of money doing it so far. So I think they kind of have to say that. But Yeah, it was extremely aggressive. He said 90% is not nearly high enough. We'll be doing 99% of all this work with AI before long.
I hate to agree with the guy, but I agree. I agree with him. I mean, there's so many repetitive tasks in 10 years.
Yes. Oh yeah.
They did. Yeah. They said in 10 years.
Anyone who's heard me talk about this,
2030, maybe. Yeah.
Anyone that's ever had me talk about this before, you'll hear me say the same thing. Look at Clayton Christensen steel mini mills. We sell a commodity, and as those things can work their way up the value chain, it's inevitable. Having with steel microprocessors, like look at the history.
Yeah.
Are we gonna be Blockbuster Video tomorrow? No. But at some point, this is an economic problem. When you can produce cheaper than humans, the end.
Yeah.
At the same rate or better. I think the challenge where there's opportunity here is like that's going to take a while, and until you can find a customer acquisition cost lower than the current LO commission, you can't replace that salesperson because they have functions that they're really not replaceable.
Well, Zillow's figuring it out, right? I mean, Zillow's figuring it out by replacing kind of in essence the sales and marketing efforts that the individual LO is designed and hired to do and compensated their 120 or 130 basis points to do, to actually sort of be the feet on the street and the connector between the realtor and the consumer to the mortgage company. Now that companies like Zillow are increasing in market share, it's almost like those old medieval like battle scenes where you don't see the troops but you hear the footsteps.
Yeah.
And I hear it coming, and so I don't think the guy's very far off. In fact, I pulled up this video of Amazon when Amazon was losing 150 million or so, and they were interviewing these Wall Street analysts saying like, how could you and this gets to your point, Jason. This is the Clayton Christensen, comparison where the interviewer to this analyst was, how could you possibly invest in a stock that or this company is losing 150 million?
Yeah.
How is this company worth more on paper than Sears and Roebuck was the question, right? And because at the time Sears and Roebuck was sort of the beam, and this is like not too long ago. This is like in the late 90s,
Which is a whole nother. Sears is a whole catastrophe because they owned H&R Block, like Discover. They had all these great assets, and they kept selling them to keep investing in retail.
So, but the whole point is, they said that like, look, we're investing in the future. So yes, they're losing money. We're going to buy their stock.
Yeah.
And so that's why and I actually sent that to an executive at Better last night, in fact, and I said, dude, this is you guys. This potentially could be you guys. You guys are at the right inflection point potentially over this next 10 years. I think these guys could really pick up a lot of market share because I think so much more of that retail traffic is starting online, which is why NFM, quite frankly, which is one of the reasons why I found attractive about the company, was that they have that influencer division where Greg is really driving hundreds of thousands of leads. Sorry, I dropped my phone. Hundreds of thousands of leads through Instagram and TikTok and different sort of social media platforms to try to get in front of the consumer as they're poking and prodding in. The other piece,
brilliant, because to the same point, like you've reduced the customer acquisition cost to the production cost of the TikTok video, which you made on your phone or whatever. I know it's not that simple because it took a lot of work to get people to look at it. But once you've mastered that, like it's a brilliant strategy. Like I give that guy a lot of credit. The whole division is really forward thinking.
Yeah.
Yeah. So yeah, I mean, to your point, like if when Zillow has now like put themselves in between and now is driving the entire transaction in the whole value chain, yeah, that's different.
Yeah.
Better but that only works.
Does Zillow own a real estate agency as well?
They do.
Zillow? Yeah.
I love it when you become so powerful where you could say we're so indispensable to our competitors that we can compete with you and you can't do anything about it.
Well, I think it's less their own agents and more that they operate a referral network and charge referral fees to agents. But I think some of both. But yeah, their purchase mortgage volume grew 80% year over year was the headline number, I think. So it's, yeah, I like that metaphor, Rick, of the battlefield, picturing like the Lord of the Rings, like hundreds of thousands of people storming the gates. Yeah,
So
it's been really interesting.
What's the answer to it though? Because they've got more money.
It's adopt or die.
Yeah. Well, it's not just adopt or die. They've got a hell of a lot more money than you. Unless you got G-Ray money or rocket money to dump, hundreds or tens of $1 million into, machine learning and automation, you got to do something pretty creative. Which is why that influencer thing is so brilliant, because you can compete on that. You can't compete with Rocket on investment in technology.
Yeah.
You don't have their budget.
The $1 billion marketing.
No,
literally.
No. Same with all those other top. You can't compete with G-Rate or any of those places. They got money.
Yeah.
I think that's why the vendor community is so important, because I think vendors will deliver this on scale to drive the cost of those technologies down by just adding hundreds of clients on it who can't afford to build it themselves.
I mean, it's a little bit of a pivot for NewsZip, where we have been, making our money by running a real estate referral network. But under the hood, we were building and have built home search and national real estate market data with different calculators and different trending and different personalized info for every single lead that our clients get. So it's actually pivoted a lot to, and Rick's seen this a little bit, hanging out with our founder CEO and I at some of the conferences lately. But there's a lot of conversations with lenders or even fintechs in the space that are like, yeah, we'd like to not spend the tens of millions of dollars that Rocket had to on Rocket Homes, or the billions of dollars that Zillow had to on Zillow, to fill out the real estate piece. The real estate piece is only one piece, but that bundling is a start. So maybe you bundle title as well, maybe you bundle insurance as well, and then you start then as a lender, being whether they're the face of it or something else is the face of it. Some consolidated bundle that competes with Zillow and competes with Rocket and competes with Better, or whatever. Better developed the real estate network as well, right? To pass things through. So that's a big part of our thesis is that we can do it. But what we didn't expect is people to come to us just for the parts and not for the real estate. But we now do that as well.
Well, I think so. Tell me, so let's start. Well, let's go with where we should have started. Jason, so you run a mortgage company. Tell us how you've grown this company and what your story is behind.
Nobody wants to care about mine, so we should keep talking about tech or the Tyson.
Because I think you're
odds have Jake Paul winning the fight.
You're a good retail operator, dude. I think you're one of the best retail operators out there, and I think it's important for the marketplace to understand that there are people out there like you that are really driving and moving the needle and getting success.
Yeah. What do you want to know? What do we do? I mean, we're an IMB, and we're a blip on all these aforementioned companies' radar. Like, nobody's ever heard of us. Nobody cares. We don't do enough volume. We could double twice, and it still wouldn't matter.
Well, you guys will do how much volume this year?
Probably 750 million, like maybe. We've grown during this. We've grown rapidly during this, but it's my same point about from the refis, right? It's from a nothing. We grew from almost nothing.
Dude, but that's what. But even there's only a handful, and I actually was bifurcating this out. I'll show you the number of companies that are actually even doing 750 million, and out of all the companies, there's not. I mean, there's more. There's a number of them, but it's like if you look at the histogram, like the chart of the number of companies based on production volume, and you start getting into like below 700 million or 600 million, and the number of companies just jump because nobody knows how to scale. You know, and I'm not faulting people not knowing how to scale, because scaling is hard.
Scaling's hard, and you know what I found in this, probably in the last 5 years. This is the third time I've done something similar. Mortgage companies, especially IMBs, are no different than any other small business. They're all the same, right? You make a lemonade stand and you do great on your corner, and you want to open a store or you get a food truck or whatever the thing is, and you want to eventually scale it and turn it into a franchise. I know how to sell lemonade. I know how to make lemonade, but I don't know how to do all the things that are required to go to the next level, the standardization, the documentation, the process stuff. And what a lot of companies do is they kind of luck their way through it, especially during COVID, right? Like a lot of people just luck their way into growth, but they had no idea how to run a large business like that. And it's a hell of a lot more work than you would imagine. And I think there's a lot of big companies right now that lack that knowledge because they haven't had to go through it. Like, where do you learn how to go from, having a taco truck to having a Chipotle franchise or whatever? Like, it's a process, and the process requires process. That's really been the thing that I think has enabled our success was, I came in here and started writing things down and making them repeatable and measurable and tracking. A lot of people they don't know to do that.
Dude, it's
there's a lot of waste in our industry as a result of that.
There's a lot of burger joints, but there's only a handful of companies like McDonald's or whatever, because people know how to make a good burger, but they don't know how to scale and to duplicate that and that is an interesting sort of analogy. It's hard, man. It's really hard to do. I'm going to do a post on it a little bit later today on just that and what makes certain companies special. Because companies like Cross Country, even companies like yours that have been able to scale to the degree that you have, are pretty unique. And it's
yours too. But somebody should study what the CEOs have in common.
Well,
I saw something you wrote recently, right? The average CEO of a mortgage company or ownership is like 65 years old.
Yep. And so
I would say the vast majority of them, except for some of your exceptional ones that have made it through the process of scaling nationally, like your 5+ billions.
Yep.
Most of them don't. I would bet have followed the same trajectory. Like, it was a sales guy that was successful and then just started kind of making their own sphere of influence larger and learned as they go. But very rarely do you bring in third-party consultants and listen to them. Like Steve Jobs, and like, let's hire smart people and let them tell us what to do. Nobody does that. That's not like human nature, right? Like, I've been successful at this thing. You're not going to come in and tell me I'm wrong. I'm not telling you you're wrong. I'm telling you you're going to the unknown, and the things that you did aren't going to work there.
Yeah. How deceptive is money?
Right.
People have made a little bit of money, and that little bit could be $1 million, $3 million. It could be $10 million. Right? And the market, just gives them manna from heaven, and all of a sudden they feel as though that they've made all the right decisions that they've ever made. And you come in and you try to give them advice, and they simply don't listen.
Yeah, that happens a lot in a lot of places.
Dude, it's literally the bane of my existence for for years.
I'd be curious to see that number you have, like the number of companies that fell below 700 or whatever. I bet a lot of them have this. It's all the same kind of symptoms of the underlying problem, right?
Without any doubt, one of
the things I've seen in that cohort is there's a bare minimum cost threshold to be an independent mortgage banker, right? Like, there's things you have to do to be an IMB. You have to have QC and underwriting and warehouses and all these things, right? And if you're not doing, like, give or take 300 million, you're not making any money.
Yeah.
That's the cost of those things.
Yeah.
I'm actually surprised more of the companies that are in that haven't, like, banded together and formed like cartels, for lack of a better term, or
like a Lenders One. I mean, that's Lenders One's value prop is exactly that.
Yeah.
Is to, the economies of scale based on you're much better. They negotiate buying power, bulk buying power based on their membership strength, and they're much better together than any individual member by themselves,
Oh, do they provide, like, capital market services and all that?
Yeah. They negotiate bulk vendor discounts and so on. That way, because an individual, a $750 million a year company isn't going to get the same kind of deal Cross Country would. But
right.
If you join a Lenders One, and then Lenders One can say, hey, we represent, Lenders One actually is really impressive because they represent about 20% of all mortgages in the country go through a Lenders One member. So they make these bulk deals. warehouse banks, with with vendors, Total Expert, and so
Payroll
on.
companies, and
Yeah,
do they negotiate like that, like a
yeah,
deal? Yeah.
yeah. No, I think Lenders One is a great option. It's a good
We were a
economy.
member. I never looked into it. We were a member there. We just I never looked into it, so I probably we paid to be a member, and then we just didn't receive any of the benefits.
I don't even know if there's a cost.
Idiots.
I don't even know if there's a cost to it, to be honest with you. But I would suggest looking into it, because they're a good organ. I can put you in touch with them for sure. I mean, I'm a big advocate of theirs. NFM's not a member, but I'd love to get NFM to be a member of them. Cross Country, was a participating member of theirs, and but
I just put TMC. That was kind of cool.
Yeah, Mortgage Collaborative is another one. Melissa does a great job, in running TMC. So I mean, I think that there's tools like that.
It's like other people to work together, right? Which you guys are big proponents of that. Like, why can't we all be successful together? It doesn't have to be my win at your expense. So that's why it attracted me to them. I just found out about it. I just found out, like I said, I don't know anything or anybody. I just find out about these things when I talk to people like you, and they tell me, hey, you should do this Lenders One. All right, I'm going to call them.
Yeah, you really should. It's a great organization. Justin, who's the president of Lenders One, is a friend of mine, and somebody that I really admire. That I really admire what they're doing.
Yeah, that's awesome.
And Justin, Brock, you don't have any partnerships with. Were you looking at Lenders One at one time or something like that, or no?
We looked at TMC. I will present tense, because I haven't done it yet. I will also do the same. I'll probably call Lenders One after this, because because I don't know Lenders One as well, but TMC I know reasonably well. They wanted to, I wasn't able to come up with a structure at my last company, Easy Knock, that made sense, but we spent a lot of time with the Mortgage Collaborative. And then, but then with NewZip, TMC has, they have an investment fund where they take some of the dues or something, some pool of money that they charge their lenders to invest in tech, to own a portion of the vendors that they recommend and negotiate bulk deals with and stuff like that. So we actually recently went through a pitch day for that. I don't think it's going to make sense for us to take that investment, or for them to make that investment even. But it was interesting that even exists. So that was cool. But yeah, we're not a member of anyone right now, but we've been a part of some TMC events as a possible investment and a possible partner.
I know when you're members of these places, you get discounts on a lot of things, including your Fannie Freddie tickets, at least the application fee. So if you're on your way to there, here's a message for all these guys. If you're on your way to that, filing that thing, and you're talking to somebody like Jennifer Whip right now, make the investment in Lenders One or TMC or whatever, because it's going to give you a discount on your application fee for the agencies. I think you get your money back.
I'll shoot off a note just to do an introduction to you guys, so you guys can. Because I've done a lot of work with those guys. They're great guys, and I think it's definitely worth exploring for sure. But beyond that, we're kind of out of time. Is there any parting words on the one thing I would say about the MBA numbers, Brock, that we talked about? But the average lender made $700 a closed loan or whatever it was. The problem with that is that it's such bastardized data.
Yeah.
I would bifurcate that to say companies doing $200 million a year made this much, $500 million, because you get the profits of a cross country that made so much, and then you get and then that ends up overshadowing the profits of companies that your company, Jason, or companies much smaller. So I'm not a big fan of broad strokes like that, but.
Well, also, you don't know if a bunch of that data, for some reason, MSR values shot up during the period because interest rates, changed a little bit during, Q3. So suddenly the transaction volume increased, right? We were holding all this. And so we sold some stuff we weren't selling. You don't know. I'd love to see it. That's actually why I joined TMC, for the benchmarking thing.
Yeah.
You need the data. I mean, that's the thing with all of these lemonade stands, You really need to ask other people how to run a business. I don't have any closing words except, you know, I really hope Tyson knocks the shit out of this guy.
Yeah.
But I also give Jake Paul a ton of credit for being a wicked good promoter. Like, I don't know what their paycheck is on this fight, but I bet it's got more than 2 commas in it.
It's a lot. Jake Paul gets guaranteed. I think it's 20 million, and Tyson only gets like $6 million for this. Like, it's really lopsided. I actually thought it was going to be just the opposite.
So he's getting a 3 comma check. So Tyson's gets 6. I wonder if he even needs the 6. Like, is this one of those? Remember he did that one fight when he came out of jail and he was like, "Look, I'm just fighting this guy because I need to eat."
Well, yeah.
It was like an Irish guy, like a big Irish, and he just like
he was from Massachusetts, yeah.
Yeah. So you think it's like this? I mean, he doesn't look like that. He looks like he's training for this like it's a real fight, but he's also almost 60. So, I mean, shouldn't you just be enjoying whatever it is? I mean, he says he was, before he got this fight thing, he was like just smoking weed and eating shrooms and chilling. He's probably got a decent life. Or maybe some financial motivation. I don't know. I grew up, I mean, Rick, you're a little, but Tyson he's the best fucking boxer ever.
Yeah.
If you don't know it, and you're a generation after me, like maybe you don't understand. You know, it's like Michael Jordan. If you never saw Michael Jordan playing a game, you would not understand it. You would think LeBron James is definitely better than him. I could understand if you never saw it.
Yeah. What's so hard? What is so hard is
now there's a bunch of haters that are going to be like, I love LeBron James.
Dude, I used to be able to dunk. You put me into a basketball game right now, I'd be lucky to touch the bottom of the backboard. It's like I don't know how this guy's going to do it, to be totally honest with you, because to me it seems really almost dangerous to have a guy like, to have him, you know.
Definitely dangerous. Yeah.
I mean, the other thing, you know all this stuff about CTEs now, right? Like, this guy's been punched in the head a lot. I think the way those things, watching the Tua, like the little bit of information about Tua Tagovailoa.
I was thinking Tua, but go ahead.
No, the more you've gotten like concussions, the more likely you are to get another one.
For sure.
So this guy, you know, fought his whole career, like, which would mean it's easier for you to knock him out now after all of that career of trauma. That's what I think he's probably got going against him.
I don't know. I'm hoping he stays safe. I'd be shocked. It's hard for me to imagine that it's not staged, because I just don't know how
it's not WWE staged, but it's staged.
Yeah.
I just don't know how a 60-year-old man can fight a 30-year-old man.
I don't know, dude. Have you seen him though? Like,
I know, dude. I know, but I don't know. It's just
I wouldn't fight him.
You know, I'd fight him.
Tyson?
Dude, I'm totally kidding.
Oh, good luck, bro. All right. Well, no, I don't got any closing shit other than that. I mean, go Tyson.
Yeah. Well, we'll have to see exactly how this pans out. You know. Yeah. Well, good. Well, good chatting, and I appreciate you being this was a lively sort of guest. Jeremy had some signal issues, couldn't join, but Brock, I think that was good. Any parting ways on your end, Brock?
No, I agree. Let's go Tyson, and good chatting with you, Jason.
Yeah, man. You guys have a good weekend.
Take care.